Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. I thought that, this last week before most of us take a little bit of a break and think about the new year would be a good time to check in with what's happening in the economy and in the markets, et cetera. And so I reached out to Karl Schamotta. He is the chief market strategist at a company by the name of Crombie. Karl leads Crombie's currency research group, covering global macroeconomics, geopolitics, central bank policy, technology, and financial markets. He regularly appears in the Wall Street Journal, Financial Times, Bloomberg, Reuters, BNN, CNN, and CNBC, and now on the Brian Crombie Radio Hour on Saga 960. Really appreciate you joining us tonight. Karl, the Canadian dollar has been persistently weak for the last couple of years. Why is that? And is it going to continue to be low, or do you think it could go up higher?
Yeah, I think in the short term, we could see a small gain, mostly because we're seeing a very big correction in the financial markets right now. Federal Reserve Chair Jerome Powell last week signaled that the Fed was moving in a very dovish direction, that they were, beginning to thinking about cutting rates, as it were. And that has led to a big sell-off in the US dollar, a big rise in basically everything that is risk sensitive on a planet-wide basis. And the Canadian dollar is sort of riding the coattails of that. But I do think it is sort of a dead cat bounce for the Canadian dollar, given that we do have these massive structural problems in Canada that have been holding the economy back and diminishing demand from global investors that historically did help to keep the Canadian dollar aloft.
What are these structural problems that Canada has that you're worried about, concerned about?
Yeah, I think the big thing is that back in the early 2000s, the idea was that Canada was sort of the Saudi Arabia of the North, that we would produce all of this oil at elevated prices, that we would ship it into the US, and that the Canadian economy would do really well. But the reality in recent years has come home, and that is that, Canadian households and corporates are holding way too much debt relative to the scale of the overall economy. So the latest figures show private non-financial debt. So that's debt outside of the banking sector at 217% of GDP. So that's, the highest in the G7, the highest among major advanced economies in the world. And, that means that the economy is far more sensitive to the increase in rates that we've seen in recent years.
Can you put that in perspective? So 217% of GDP, is that what you're saying?
That's right.
And how would that compare to either history or to the United States or other, reasonable comparables, so I can put whether that 217% is good or bad?
Yeah, so the US is about 156% of GDP and has come down relatively smoothly since the global financial crisis in 2008. Around 2008, I think that they got to about 175, 178% of GDP there. So Canada not only has been increasing at a steady rate for decades, but it has outpaced the US at the peak. It has also outpaced, for example, Japan back in the 80s, probably the biggest debt bubble on the record. And I don't know if you remember this, but at the time, the land that the Imperial Palace in Tokyo sat on was worth more than the state of California. Debt levels had gotten very, very out of control there, and they came down ever since. But the reality is that Canada is well beyond those levels that triggered that big downslide in the Japanese economy back in the 80s.
Which would have been less than 217% of GDP?
Yes, at the time, I think it was around 160% of GDP that was held outside the financial sector. That being said, there's a bunch of different issues with how the Japanese economy was composed at the time, but very, very similar in a lot of ways.
Really, that's kind of scary. I saw this chart that I think suggested that our debt to GDP was comparable to the United States in 2008, prior to the financial collapse, the global recession, and then after that, the U.S. went down because of housing price declines and bankruptcies and things like that, and reduced debt but Canada just continued to go on straight on trend line and increased for the subsequent 15 years.
Yeah, I sometimes make the joke that Mark Carney, who was the central bank governor at the time of the 2008 crisis, he might have been a little too good at his job, given that global investors just decided that Canada was not at risk. Money essentially kept flowing through the Canadian economy. We had a very, very shallow downturn in home prices. Debt levels did not come down. And the party kind of kept going, which is also humbling because, if you look at that period, if you were looking at the financial markets, if you were looking at the Canadian economy in 2008, it certainly would have looked at that time as if, doom was on the horizon for the housing bubble and for the Canadian economy overall. And that did not actually happen.
Okay, so I interrupted you to clarify. You're under your concern about too much debt. What were the other structural problems that you're worried about in Canada today?
Yeah, so very much related to that debt problem, the reliance on real estate and real estate related activities to drive the economy. So not just construction and building of homes, but the spending that is being done by Canadian households who are essentially using their homes as ATMs, much like the U.S. did back in 2007. We have an overdeveloped public sector relative to the scale of the economy.
Hold it. Overdeveloped sounds like a positive thing. What do you mean? We're fat?
Yeah, I would say we're too big. The reality is that the public sector is capturing a greater share of GDP than ever before. That is happening across most developed economies, but it is happening at an accelerating pace here in Canada. I think that does pair with that broader idea that we have poor labor productivity. I know that you've had many guests in the past talking about that, but that also impacts our competitiveness in the world, right? Exports are extraordinarily weak, and export growth, even including oil prices or oil exports to the rest of the world, has dramatically underperformed relative to the rest of the G10 or the G20. We're very, very close to the bottom of the league tables over the last couple of decades, given that the economy has effectively shifted onto a import focused growth model.
But why would we be so poor in exports if we've got all these natural resources that the world is clamoring for?
Well, I would say there's a couple of things going on. One, Canadian companies are simply not making what the world wants. We're having a lot of difficulty competing with low cost centers elsewhere in the world, like, for example, China, as a huge exporter of manufactured goods. That is, certainly leading to a hollowing out in what's happening here in Canada. But I would also say that, fundamentally, the structure of the Canadian economy has shifted, that we're seeing sort of an economy focused on the wrong things for the wrong reasons. And that is due to economic incentives, fundamentally. So, I think that this is not the fault of any individual in the country, or even a group of policymakers, but more fundamental to how the global economy itself is structured.
Why is our productivity so low?
Well, I think the big issue here is those economic incentives that I was speaking of. That essentially what has happened within Canada over the last couple of decades is that we have shifted toward a model based on building homes, on consuming beyond our means, and as a result, the manufacturing sector, for example, the services export sector, they're competing for scarce investment, scarce resources, and scarce labor when they're looking to expand operations and sell to the world. So when all of that is happening, you have a difficult time actually deploying new technology, because you're not sure that that the demand is going to be there. You have a difficulty in hiring new workers and investing for the long term, because you are dealing with extensive uncertainty. And all of that holds you back. If you talk to CEOs and CFOs across the country, they will all tell you, that those issues are what's fundamentally hampering that the drive to expand in the long run.
So you're suggesting that because the real estate market was such a great place to invest over the course of the last 2 decades, it stole capital away from more productive manufacturing, innovative parts of the economy? Seriously?
Yes. Yeah, I think so. Not just the fact that that money was pouring into those types of activities, but also the fact that that consumer demand shifted, right? So, and I guess where this kind of comes through, especially when we think about this from the currency market perspective, is that I would argue that Canada had a case of what they call Dutch disease. Have you ever heard of that term?
I certainly have.
Oh, nice. Yeah. So for the listeners, the idea of Dutch disease is that when, for example, when the Dutch discovered oil back in the 70s, the value of the currency went up dramatically because this big surge in export revenues was expected to deliver big benefits to the economy. But the problem was that when the exchange rate went really, really high, because all this money was flooding in, it actually starved the other parts of the economy. It made it very much more difficult for anyone who was exporting to actually survive. And so what we've seen in Canada for a couple of decades really is a persistent period in which the Canadian dollar, the loonie, was relatively overvalued, right? So investors around the world thought we're the place where the oil is. We're, a nation composed of very prudent, conservative consumers, and we're a great place to park to park capital. And so, unfortunately, I think what had happened in that process is that business owners across Canada, individuals, even like individual investors, individual workers, they decided that the greatest opportunities in Canada were to be focused in the consumption driven areas of the economy. So in other words, it made way more sense to go, sell luxury goods than it made sense to provide a software technology that got exported to global markets. And so, unfortunately, this is not necessarily due to some flaw in how Canada has managed it. It's more what was happening from a global perspective.
Really, that's fascinating. You're almost suggesting that, I had always thought Dutch disease applied to, as you mentioned, oil and gas, and that the Canadian currency would be overvalued. You're almost suggesting that we had Dutch disease in luxury goods and Dutch disease in real estate. And those two sectors stole from the balance of the economy.
Yeah, I mean, I would suggest that really where it comes down is that where the Dutch were exporting, oil and gas to the world, we've been exporting debt to the world, claims on our debt, so financial instruments to the world. So that sounds kind of abstract, but if we issue bonds here in Canada and we lend to Canadian citizens, we have created a financial instrument that can then be sold on to someone else in the world. And if we look at what has happened in the last, really, even prior to the global financial crisis, but accelerating in the years since, it is that the world has demanded ever larger quantities of these financial assets, whether they're homes or bonds or equities. And that has led to a flow of cash into certain sectors in the Canadian economy. And so that was really our superpower to some extent, was that ability to attract all this capital from the world. Now, I don't know that that's going to be sustained, but it certainly is something that was due to that global economic structure, not just what was going on in the domestic Canadian economy.
Fascinating analysis. You're suggesting that really the Canadian dollar is low, and you're talking about potentially it could come up because of a dead cat bounce, which is a line that I haven't heard described to our currency before. And so it sort of puts it into perspective. And that you've talked about several structural problems that we've got: too much debt, high reliance on real estate, a big public sector that's only getting bigger, poor productivity, and weak exports. And now you're talking about that we create all these financial assets that we export around the world, and that's creating more of a problem. It almost sounds like you think debt is a four-letter word. We're going to take a break for some messages and come back in 2 minutes with Karl and talk about what caused this situation that we're in today. Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're talking about the economy, what is currently happening, what the problems are in Canada, and where we might be going in the future. My guest is Karl Schamotta. He is the Chief Market Strategist at Corpay. Karl leads Corpay's Currency Research Group, covering global macroeconomics, geopolitics, central bank policy, technology, and financial markets. And if you've been listening to the show so far, you can tell Karl is a pretty smart guy. Karl, you've told us about our challenges, and you've described this dead cat bounce that is potentially, the Canadian dollar is in store for. And we've talked about some of the challenges right now with the Canadian dollar. And we've also talked about some of the structural problems holding Canada back. I got to ask you, how did we get into this situation? Is this a failure of political leadership, or of the economy, or of private business, or what?
We got to find somebody to blame, right?
Exactly.
No, and I think political leadership has had something to do with it. But I think the big issue here is that Canada is ultimately a small, open economy, and we're part of a global problem, right? And I know that you've heard about this a lot, talking to prior guests when they talk about what's happening to housing markets. It is not just a Canadian phenomena. It is something that is happening all over the world, especially in English-speaking common law economies, right? So, I think the big deal here is that what has been happening for a couple of decades is that financial assets have risen in value far faster than incomes, right? The volume of global capital has grown far faster than underlying consumer demand around the world. And so what is going on in our housing market, in the economy overall, is that global capital keeps looking for bottlenecks. It keeps looking for places where, where when money flows in, supply cannot necessarily increase quickly enough to meet the demand, and prices continue to go up, right? So we've seen this go on for a couple of decades again. We've seen it go into commodities, into cryptocurrencies, into all sorts of things. But housing is one example where the supply has remained restricted for so long that it's led to persistent price increases. Now, why is all of that happening? Because if we look at how much of the global economy is structured, we have a situation where authoritarian governments in China and the Middle East, for example, built economies that were based on exploiting workers, right? That the elite were capturing a huge share of national income. The workers were not getting paid enough to actually consume the products that they were producing. And that meant that all of the capital being earned, or a big share of the capital being earned, had to be redeployed into global markets, right? So whether you're talking about, the sort of oil dynasties of the Middle East, or if you're talking about China, a huge share of the income being generated by those countries is recycled back into Western financial markets. At the same time, we have the baby boomers who have been, saving for retirement for decades, right? And deploying that money into the financial markets through pension plans, as well as their own individual savings accounts, right? Central banks kept stepping in to lower volatility every time that it did look like we might have a reversal in the capital markets and any type of loss. And the last thing I think that's very, very important in all of this is that, and very positive, I guess, is just that humanity became far, far richer, right? In the 20th century, the world generated more inflation-adjusted GDP than in the 19 centuries before it. In the 21st, we're likely to have already done the same. So like just in the last 22 years, we did as much GDP as they did in the 20th century. So all of those factors drive down global interest rates. They give Canadian lenders the money that they need to inflate the housing bubble. And that ultimately keeps getting bigger because supply can't be built quickly enough. So this shifted the whole economy. Canada went from being, sort of a strong export-focused economy to being far more reliant on ever-increasing home prices and financial assets, and being reliant on credit-fueled consumer borrowing, right? So all of that just fundamentally isn't sustainable, but it is the thing that has generated so much of the growth in Canada for a very long time. That was a very long soliloquy. I'm so sorry.
No, I appreciate it, but honestly, I don't understand. So why is this all bad? So what you're talking about is that we've got a lot of global capital that started coming to Canada because there were good opportunities. We added to that incomes from the baby boom. And the baby boomers that had increased wealth, and they lent us the money, and we were buying luxury goods and houses at cheap interest rates, and we got a lot richer. And you said that we're the wealthiest generation in history because of that. So why is that all bad? Because
It's
it
not.
can't continue forever?
It can't continue forever, right? I don't want to necessarily quote Maggie Thatcher on this, but she said something like socialism is good until you run out of other people's money. We might be in sort of a similar challenge here in Canada. Is firstly that money does tend to run out, right? Like the factors that have driven that big tide of global capital are beginning to reverse. We certainly saw a pretty profound reversal during the early months of the pandemic. It does look as if global interest rates have reset higher. But also the bigger issue, and something that sort of runs as a theme through what we've been talking about, is just that misallocation of resources in the economy, right? When everyone's borrowing money, spending money, that is not necessarily directing investment to the right areas of the economy, to the areas of the economy that ultimately increase productivity. So things, like deploying new innovations, like exporting to the world, have not been receiving the investment, while other areas of the economy have. And that's, fundamentally where I see the issue. We've been kind of been partying for a while. Now it's sort of time for the hangover.
But you're also suggesting that part of the problem is that we have had a limited supply of housing, and so therefore the assets that were there, the houses that were there, got bid up. Why have we had this limited supply?
Right. So I think there's a lot of theories on that, lots of ways to kind of slice and dice it. But ultimately, without doubt, the sort of NIMBY phenomena, the regulatory overhead, those are the biggest factors in making this happen. Right. And the unfortunate reality is that it doesn't look like that can change anytime soon. We are seeing, increased pressure on municipal, provincial, and federal officials in Canada to, streamline that regulatory overhead, to permit people to build what they need to build more quickly and without as many procedural delays. But the reality is that you're in a market in which so someone once talked about inflation. They said, essentially, if you look at the things that have gone up in price for the last couple of decades, they're anything where governments are, on one hand, subsidizing demand, and on the other hand, restricting supply. And so, if we look at the housing market in particular, but you can also look at, medical care or anything like that, we're in a situation where we have both forces happening at the same time, right? So we have governments that try to support homeowners in buying homes while also working on the other side to restrict the supply. This is perfect for financial markets. Financial markets love this. This is an opportunity to go in and invest in something that is very unlikely to backslide anytime soon.
Sounds like you're going to go from quoting Margaret Thatcher to Ronald Reagan. Wasn't he the guy that said something like governments aren't the solution to the problem?
Yeah, he did. The funny part is that it probably should tell you something about how this is all going to pan out. He did say that governments were not the solution to the problem, but then presided over a massive increase in government spending. So what I find sort of challenging about the current political environment in Canada and elsewhere is that people on both sides are telling us that they're going to, put the restraints on, that they're going to, become more fiscally responsible, and that they're going to, take government out of everyday life. But the reality is that we just haven't seen any backsliding in generations, right? Governments have gotten bigger, more intrusive, and as they've done that, that has limited the flexibility of many areas of the economy to actually respond to shifting, supply and demand forces, right? That's really what it all comes down to.
So in the 1990s, the early 1990s, we were in I think, a sort of a similar situation. Some people called it the Canadian peso crisis because it was similar to what was happening just a few years earlier in Mexico with a collapse in the peso. And Paul Martin, the Minister of Finance at the time, Jean Chrétien, the Prime Minister, actually not right away, but after a year or two, instituted fairly sizable 20% reductions in government spending, including transfers to provinces that obviously impacted healthcare, et cetera. Do you think we need that kind of 20%? Not like right now, what we're doing is sort of slowing the increase. We're not even decreasing. Do we need like a 20% reduction in government spending?
Well, the interesting thing is it's not necessarily the spending. So if we look at overall debt levels in Canada, they are relatively high, certainly relative to history. But the problem in Canada likely is not actually on the government balance sheet. It's not that, that the federal government or the provinces are about to get themselves in a lot of trouble from a spending perspective. However, I think that the incentives within bureaucracy are skewed in the wrong direction, right? So the more that we hire public servants, the more that we incent those public servants to slow down processes, to add additional steps to things, to implement new rules, the less that the economy can prosper, right? So I don't necessarily think it's about money. It's about the philosophy of what government is there to do.
So it's
right?
Red tape, bureaucracy.
That's right.
I interviewed someone that said that we in Canada have the slowest housing approvals in the Western world and the G7, and the slowest approvals for things like natural resource developments, mines, etc.
I'm not shocked. I think that might have been a CMHC piece of research, and yeah, very, very impressive, because it's difficult to quantify, right? It's hard to figure out where all of the different steps are involved, and difficult to follow the process through. But it's really beyond doubt that that it's become far more difficult to do anything relatively basic, and this is really appalling if you think about it from a global perspective, or if you think about it from a private sector perspective, given the fact that governments at this point have far more advanced technology at their disposal to drive down these costs and drive down the processing times and all of that. We should just be far more efficient at what we do. And
it should
I would
but
say,
every single time they try to use technology, they seem to have a disaster, whether it be the ArriveCam app or the eHealth app or whatever. It's we don't seem to be able to institute major technological change in government at all. Well, why?
I think it is the incentives. I think it's difficult to move a bureaucracy that's not paid to from a performance perspective. I think ultimately this is much like teaching. I think at the end of the day, we should be paying high performers. We should be paying departments that do manage to reduce costs, that do manage to generate greater deliverables. We should be paying them more. And I know that this is always sort of repugnant to people within the household sector. Most people don't think that they should pay the government more. But if we can get the government to actually deliver, better results, I think the individuals within it should be paid more. And it's kind of ironic if we think about this from a much broader perspective, right? Quite often we see this in like international development economics, where countries with relatively high levels of corruption can sometimes move forward very, very quickly because the people involved are getting paid extra for doing so. I'm not recommending that we do that, but the fact is that if we look at China's development model, for example, the corruption that was embedded within it for many years might have actually helped them move up the ladder. And so in Canada, at the end of the day, we should have, very clear transparency into what is happening within each department. What are the deliverables? We should know how long it is going to take to get a passport application approved. And we should be able to benchmark that against what the performance was the year prior, right? That kind of stuff is imperative to building a incentive structure that gets people doing what we want them to do.
Karl, this is a fascinating conversation. If people want to follow you and read some of your writings, how do they best do that? Is it on Twitter or X or LinkedIn or your website or what?
Yeah, I guess all of the above. Check us out at Corpay, so that's CORPAY, currencyresearch.com. Or just follow me on any platform pretty much. My name's Karl, KARL _Schamotta, SCHAMOTTA.
Karl Schamotta, really appreciate this as a concerning but helpful description of what's going on in the Canadian economy. We're going to take a break for some messages and come back with Karl in just 2 minutes. And we're going to talk a little bit more about what the future is and how we get out of this challenging situation that he's described. Back in 2 minutes, everyone. Please stay with us. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. I'm trying to put the current Canadian economy into perspective so that, as you're sitting around some of these holiday dinners that we're having and, after we find out how the aunts and uncles and cousins are doing, we tend to talk about the economy and politics. And one of the things that's going to come up is interest rates and housing prices. That we've got the perspective of a really smart gentleman. Karl Schamotta is our guest tonight. He's the chief market strategist at Corpay. Karl leads Corpay's currency research group. He covers global macroeconomics, geopolitics, central bank policy, technology, and financial markets. Karl, let's turn to it. The big question that's going to be asked at the dinner table: are housing prices going to go up? Are they going to go down? And when are interest rates going to hopefully go down?
Yeah, so I think housing prices are going to stay relatively flat. Like I think we probably are going to see some further depreciation, especially in inflation adjusted terms, over the next couple of years. But at the end of the day, the big kind of narrative here is that the big gains that we were seeing prior to the pandemic and even in the year after, those are probably in history's dustbin at this point. So I think that the big point here is that income should continue to narrow the gap between house prices and what households actually get. And then that comes into the broader context of what's happening to interest rates. Interest rates are very likely to come down a bit from where they were. Inflation's coming down very quickly. Canada's likely headed into a recession right now, but we're still very likely to hold at higher than pre-pandemic levels. And so that means that the pace of new lending in the economy, of credit growth, that's likely to remain relatively slow for a prolonged period of time. And that essentially that the Canadian economy is going to have to find a new growth model.
Long-term bond rates have come down of late, even if the short-term rates haven't. Why is that?
Because mostly because the inflation rate across the global economy has subsided quite quickly, perhaps more quickly than many people expected. And in fact, I would almost suggest, and I know that it was a bad word for a while, that the big inflation shock was ultimately transitory. So, that was definitely sort of a swear word in central banking circles at one point. But the reality is that those supply chain issues have been largely resolved. The big surge in demand that came from the US, that came from fiscal spending, that came from households changing their buying patterns, that has gone away. And at the same time, China is doubling down on its growth model. So they are, essentially putting more and more money into factories and into building stuff. And so as they do that, we're having a global disinflationary force that is allowing central banks to step back from that tight monetary policy, and it's putting pressure on long-term yields. So ultimately, there is something fundamental happening, but it is driving what investors expect of central banks in the years ahead.
So, housing prices to incomes, I think, a few decades ago were like 3 times personal disposal incomes. I've heard that they're over 20 times today.
It depends on how you measure it. I can actually, I'll send you a chart that goes viral every once in a while that I started doing about 10 years ago. But if you look at the scale of incomes, of property price gains relative to incomes, at one point we were over 300% in real inflation adjusted terms from 1975 through 2023, early 2023. And that really sort of illustrates the fact that those home prices had peeled away from the basic sort of carrying capacity of a household, right? Now I do expect that that'll converge, and arguably it's already starting to happen. But we're still at levels that do defy anything that we had seen prior in history, right? If you just look at price to income ratios, they're way out of line with anything that we ever saw prior to this period.
But yet you say that you don't think housing prices are going to come down, and you said earlier in the conversation, housing bubble, real estate bubble, but you don't think it's going to burst. Housing prices in the United States went down by what, 20-30% in 2008, 2009 during the Great Recession. We haven't seen that kind of decline. At least I don't think we've seen that kind of decline at all, anywhere close to it right now. And we do have governments that are trying to increase supply pretty aggressively. And I think that one of the reasons why housing prices continue to go up and why demand was so strong was because people thought it was a slam dunk that you were going to have appreciation. And so therefore, even if you're, reaching like crazy to afford a house, if you think it's going to go up better than inflation, it's a good investment as well as a place to live. And so therefore you'll do it. But if that expectation of housing prices goes away, what's going to happen? I get probably an email every half a day talking about, new better price, or on a house, or assignment sales on pre-construction condos, or liquidation opportunities. You never used to see that before. So why do you think housing prices are not going to go down? They're going to stay flat?
Well, I think they will go down in inflation adjusted terms. So, the ticket price of a home is unlikely to keep gaining like it did. But I don't think that we see this huge decline, mostly because of differences in the Canadian financial system relative to the US, right? And here's the key thing is that it would be good for Canada if we did see home prices go down, I would argue, particularly for the economy. It would be very good if we had a relatively swift adjustment process like the US did, and we just moved on. However, the reality is, and if we look at the history of this, that mostly Canada tends to, kick the can down the road. Bank officials, officials within the government, pretty much everybody, across Canadian society has an incentive to keep prices relatively stable, and they're going to do so. That's unfortunately not good for the economy. But I don't think that the predictions of a 2008 style crash in Canada are all that realistic. I'm not a bull, though, to be clear.
Well, we did have a 20% decline in the early 1990s in housing, did we not?
Yes, and I wouldn't be shocked if, from the peak to where we are in a couple of years, that it does amount to a 20% decline. We've already seen, 10 to 15% decline if you think about it from a inflation adjusted perspective. And so, further weakness is quite likely in the next couple of years. But unfortunately, so here's the concern that I have, right, is that many households or many individuals within Canadian society are almost hoping that we have a huge housing price crash so that they can kind of come in and buy things at the bottom, where I just don't think that hope is all that well placed. However, if we have a long period of time in which incomes steadily rise and converge with where home prices are, so home prices stay flat and incomes continue to increase, that would narrow the gap, and so that would mean that for many people in society that the imbalance is not as profound as it appears right now.
You said that we have to find a new growth model. How
Yes.
the heck do you find a new growth model, and what is it?
Well, typically, we do need to suffer some form of a recession, and I think that we are going to have a relatively painful transition in the next couple of years. So, firstly, we should have a period of relatively prolonged currency weakness. That's going to hurt household spending power, especially when you're traveling or buying goods made outside Canada. I think we're going to have less credit growth. So that means, lower consumption at a household level, lower overall growth. Businesses that, currently serve Canadian consumers could face more difficult times in that context. But when we do have scarcity like we're about to face, that often increases productivity. We see businesses, sort of forced to adopt new technologies and to look for new markets. And so, we could see actually sort of a productivity renaissance in Canada in which economic incentives sort of shift from, renovating houses toward building things that the world wants, right? And so, I think fundamentally that Canada will emerge from this in a stronger position, that, that it's going to be focused on serving global markets, as well as Canadians, and that ultimately that's going to mean that we have a more stable and successful economy in the long run.
So you would be a buyer of Canadian currency?
In the very long run, perhaps, but certainly not now. Right now it does look as if the gain that we're seeing, just as global financial conditions ease, is not going to be sustained, and that at some point next year, investors will come back to taking a short position on the Canadian economy.
I like your prognosis, but I wonder if it's actually achievable. When you think about the carbon taxes, the restrictions on oil and gas developments, when you think about our regulatory red tape burden on getting new natural resource mines and natural gas or oil installations approved, pipelines approved, etc., we don't seem to be moving very rapidly to this new growth model.
Agreed. And I think this is the brilliance of democracy, though, is that when the political winds do shift, we eventually do see change. Admittedly, it can take way too long, and we can suffer a lot of damage in the interim. But right now, if you go across Canada on the left and the right side of the political spectrum, you see opposition to these measures. Right? People do not think that they're supportive of the economy overall. And I would also point out that, we've seen similar political shifts occurring elsewhere, right? Like Germany, for example, prior to the war in Ukraine, had a very, very different political landscape. And they've emerged from this saying, we do need to prioritize having access to, homegrown energy sources. We need to, have a more sustainable model than we had before. I think that, where Canada's going right now is admittedly a reckoning, like it is going to be a period of upheaval, but ultimately the voters will choose to put pressure on politicians to roll back some of that red tape and to focus on supporting the economy and growing the size of the pie, as opposed to splitting it up.
Fascinating prognosis and projection for what is going to happen and what needs to happen. We're going to take a break for some messages and come back with some concluding comments with Karl in just 2 minutes. Stay with us, everyone. We're going to figure out how we're going to fix this Canadian economy. Stay with us. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Karl Schamotta. He is the Chief Market Strategist at Corpay. Karl, I think you said that people can follow you for your writing at corpay.com?
Yep, corpay.com is the company website, and then we also have corpaycurrencyresearch.com, which covers the Canadian economy and most of the global economy, and is free for anyone to access.
So you've been really excellent at putting our current economy in perspective today. You've talked about how the loonie is undervalued, that the U.S. dollar is overvalued. You gave a lot of reasons why the loonie would stay low, but you also thought that we might get a dead cat bounce, which is an interesting description of what might happen to the Canadian currency. You talked about a bunch of the structural problems that is holding Canada back, too much debt, too much reliance on real estate, too big of a public sector, poor productivity, weak exports, which was a pretty negative assessment of what's going on in Canada today. You talked about some of the reasons why, and interesting enough, you blamed a lot of it on financial capital, global capital that came to Canada to finance a lot of this debt growth. And you compared Canada's government strategy with authoritarian governments worldwide that had a mercantilist kind of export driven growth strategy, and we just sort of allowed luxury goods and real estate to attract a lot of the capital that was coming into the country. And we talked a little bit about interest rates, and you thought that long-term interest rates that have come down would continue to go down, and short-term interest rates, I guess, that you thought would come down, but maybe not right away. And then I thought you would say that the housing market would decline, and you were reasonably sanguine about what was going to happen in the real estate market. You thought it would stay flat, but go down in inflation sort of adjusted basis. And then we talked about hope for improvement. And I guess I want to bring back to that, if I could. You've described a pretty negative situation for Canada. You've talked about us having more debt than any other G7 country. And I think that exists both privately as well as publicly. we have gone through times like this before, and I'm thinking about the late 1980s, early 1990s, and I think about the amount of change that took place at that point in time. We instituted free trade, which was a dramatic change of what was going on in the Canadian economy at the time. And then we cut government spending by, 20%, which was a fairly dramatic change. I don't see an appetite for that kind of dramatic change in Canada today. But yet, given what you've described, don't we have the need for that kind of dramatic change?
I think we don't have the shock that is necessary yet. So, certainly in the 80s and the 90s, the entire global economy was getting pummeled by a series of shocks, right? And so that turned the focus eventually on Canada's position within the global economy. But, it took many years for that to actually happen. And so what I would expect in Canada is more of a gradual adjustment process. Certainly, it could be painful for people involved to some extent, but it should be a much more nuanced and how shall I put it, incremental process toward rebalancing the economy. And funny enough, just given that I'm a currency guy, maybe that's why I focus on it, but a lot of this could come through in the fact that the Canadian dollar could remain low, right? So if the Canadian dollar remains relatively low, that means that our exports do become more competitive over time, and that importing things into the country isn't as cost competitive as it once was. So long term, this process could be driven by what we see in the financial markets, and it does not necessarily need the absolute chaos that we did see back in the 80s to make it all happen.
Well, you've got a far more positive outlook as to what needs to happen than I am right now. I think we need a far more radical restructuring of our economy, and we need to have governments that address these challenges. I do think that the regulatory burden, the red tape burden, the time for approval of real estate projects and of natural resource projects and other things like that are a real issue. And I think housing prices need to come down. And a lot of people talk that would be a real negative to people that have got homes and they're going to lose net worth. But I think that's sort of a paper loss, because if your housing price goes down but you sell your house and you move into another house that's also relatively cheaper, you haven't lost anything. And similarly, when housing prices are high, it's sort of a paper gain, because if you sell your house and you got to move into something that's equally expensive, you haven't actually gained anything. So I really think that.
Yeah, you know what? That's all right. And the funny thing is, so firstly, I would agree with everything you're saying. I think we do need all of those changes. I just don't think they're going to happen, the way that we would, prefer that to occur. But the other fascinating thing is that if you look at the polling, it does suggest that most Canadian homeowners know that their homes have gone up too much, and that they're willing to, accept that they should go down a bit in order for society to come out in a more balanced way. Right. So it is kind of crazy to know that, many Canadian homeowners themselves already know that this has gone too far, and that, this is choking off prospects for growth in the long run.
Karl, bottom line, are you optimistic for 2024 from an economic standpoint in Canada, or are you pessimistic?
Pessimistic. I think at this point, most indicators are showing a recession at this point. Whether it's deep or not is an open question, but I do think that the Canadian economy will slow through early 2024.
Karl, I've really enjoyed chatting with you. I really appreciate it. If you want to come back maybe in a couple of months and check in to see how you've done in your projection, I'd really appreciate it.
Absolutely. Thank you.
That's our show for tonight, everyone. I appreciate you joining us. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 AM. Next week, I'm going to be repeating shows during the break between Christmas and New Year's. And I'm going to have a couple of different economists comparable to Karl and political leaders nightly talking about what their prognosis is for the Canadian economy in 2024. And I think it'll be an interesting way to put in perspective what we need to do in Canada to restructure our economy, and what we need from our governments to assist us in that process. Karl, I really appreciate you joining us. You really put it all into finite perspective. Thanks so much.
Thank you very much. And I look forward to seeing how bad my forecasts were.
Good night, everybody. Thanks for joining us.